Welcome back, everyone. It's Howie, and I'm joined by Michael Simpson, who is going to talk about how we can plan to not only sell our business in the future, but how to think about the accounting needs and some of the bookkeeping needs, even when we're just starting up, to make sure that we have this in the right shape. And I think Michael will agree with me that if we actually spend a little time on planning early on, you can save yourself a lot of pain, a lot of effort, and a lot of expense in the future when you just decide on a Tuesday you want to sell your business, or a buyer on a Thursday approaches you and you have to scramble and realize that nothing is organized. So Michael, thanks again for your time and for joining us. Do you want to start with a little bit of your background and a little bit on your firm, and then we'll go through some questions?
Sounds great. Thanks for having me, Howie. So we're located in Springfield, Delaware County. We're about 15 miles outside the city of Philadelphia. I started here back in '93 as an intern. There was 3 of us then. Went full time in '95, and now we have about 45 people in the firm. I'm a CPA that specializes in tax and valuation work. Along with being a CPA, I'm also a CVA, which is a Certified Valuation Analyst, and I've helped a good amount of clients hold their hand not only through starting a business, but also help them through walking through preparing for the sale and executing the sale.
Excellent, thank you. And do you work with clients just in a certain region of the country? Is it more nationwide?
I would say in the tri-state area, since we're located right outside of Philly. A lot of clients in the Philadelphia area, the Jersey area, the New York area, the Delaware area. That's probably the main focus of where our clients are at. However, with technology nowadays, I do have clients in California, Florida, and all over the country.
Excellent, excellent. So great. So let's start at the beginning with more of an early stage business. So we're framing this more towards e-commerce store owners is really kind of the majority of our audience. So when you're thinking about an early stage business, or someone who's maybe just starting up, what are some of the best practices to avoid future pain when it comes to thinking about either setting up their books or thinking about working potentially with a CPA firm as they're maturing? Like where do they start, just to again save some future pain?
Okay, great question. So number one, get a good attorney. Okay, and depending on the setup of your business, if you're an LLC, make sure you have a strong operating agreement. LegalZoom does a great job. However, if you're looking to eventually sell your company and you have partners, make sure the operating agreement is extremely strong. The operating agreement kind of dictates, especially on the sale, of how it's sold, or if you're going to value the company, how it's going to be valued. So number one, don't be afraid to spend some money on a good attorney. Number two is try to get an accountant in there or a firm in there as soon as you can. It could cost you some money in the long run if you bring somebody in mid-game to kind of unwind the books and get them straightened out. So my most successful clients have spent money up front in those 2 areas, and it's really helped them in the long run.
Yeah, I think that's a great point, and we get this question a lot, is especially if someone's starting up, maybe I always joke, like maybe someone's cousin Vinny is doing their taxes, or same thing on the legal side. They'll for startup or even thinking about through a sale, they might use their cousin who does wills, or maybe the cousin who helped them on the closing of their house on the real estate side, and that's not the right target. So what's the point where an early stage, or even just a startup e-commerce store owner, should think about working with with a CPA or a firm if they've had their personal taxes, and maybe they had a smaller business in the past where whoever was doing their personal return was handling some of their business returns maybe as a favor, or just doing the light side of it? When's the right point for that transition? And then maybe even the second part of the question is, how do they transition that from someone who was maybe doing their individual taxes in a little business preparation to when this is starting to scale and starting to get some legs under it? So what's your thought on that transition, and how should that be handled?
how I normally like to be involved, Howie, is right up front. Reason being is just starting from scratch with the client is making sure you can understand their business. And I have a lot of times where it's, my brother-in-law did my taxes. Um, he's been working on the books, helping us out for the last couple of years. And then you go in there, and it's not the guy's full-time job, and he's not getting paid for it, so he's not giving it the best effort. So normally we have to unwind the books, make sure to get them straightened out, because it can snowball. It really can. It can snowball into a mess, and getting that mess corrected usually takes time and it takes money. Day one would be so important to get the accounting software set up the right way, to get some training from the accountant and a staff member from the accountant. It's so important to, even though you would think this would be pretty basic, but a lot of clients don't know the numbers as well as they should. And it's really our job to educate them. And you don't want to educate them halfway through the game. You want to educate them from the beginning when the numbers are a little bit smaller and it's a little bit easier to understand, because you're going to make some decisions based on those numbers, whether to hire, whether to fire, whether to buy a business, whether to sell a business. So the sooner they get in, the better. Again, if I would recommend day one, the accountant, as soon as the attorney's done the operating agreement, you give it to an accountant to look over, and then the next day you get up and running with the accounting firm. As far as transition wise, if you have somebody that's in the middle of it, using their cousin Vinny doing the taxes, I'm sure he's doing a good job, but if it's not what they do day in and day out, I would highly recommend that you switch over, because even in inception, the entity type may not be the right one, and once you select your entity, you're kind of going down that road, and it's really tough to undo. So that's another reason to get somebody in there as soon as possible.
Yeah, that's a great point. I think the earlier that you start, even if there is some cost up front, it's just going to be much better in the long run. And the easiest and the cheapest way to fix something is before you started, right? And before you've done it, right? So I think that's a great point. I think that's what happens a lot, is that many e-commerce stores start as a side hustle. They start as a side project, and someone has a full-time job or some other responsibilities, and then all of a sudden it takes off and it starts to take a life of its own. And then by that point you realize, like you said, that it snowballed, and you have 2 years of returns that maybe weren't filed correctly, and there's been no tax planning, and then all of a sudden it's a lot more expensive to try to fix it after the fact and get it in order. So I think that's a really, really good point. Is the best time to start is today, if if you're already in the middle of something in the operating business, and the better time to start if you're starting something new would be literally, I think that's a great way to think about it, the day after your counsel, your attorney wraps the operating agreement, you should start with tax and accounting.
Absolutely.
So I think that's a great sort of timeline.
And a lot of times the business becomes the biggest asset of the family. It becomes, outside of your home maybe.
Yep.
The business is the biggest asset. So just getting off on the right foot, it's just so important.
Yep, and that's a great way to think about it. It is an asset, right? And even if it started as a hobby, right, it grows into hopefully what a significant asset, or it's a great way to think about it, maybe even the family's largest and most important asset. So you mentioned LLC versus C Corp versus obviously S Corps and whatnot. Can you talk a little bit about that? Maybe if an e-commerce store is just starting up, and then maybe we can comment on if they have a structure that's maybe not the most tax efficient, and thinking about if there's sort of a reasonable time or a way to think about even transitioning or converting.
Really important decision. It depends on it depends on your strategy. A lot of our clients choose to be an LLC. So an LLC can bring in, what's great about an LLC is the flexibility involved. So Howie, you and I are partners, and we're members, are called, in an organization, and we start out together, and we're making widgets, and we're 50 owners, And after year 1 or year 2, you're doing 90% of the work, and I'm playing golf and not really paying attention, and I'm doing 10% of the work. What's nice about the LLC is that we can change how the profits are distributed. So after year 1 or 2, you're doing 90% of the work. Obviously, you want 90% of the profit, so you can do that. You can take the 90%, and I take the 10. So LLCs offer a tremendous amount of flexibility. Now, C corps, and I've seen clients with C corps, not as popular as the LLC in the small business community. However, usually it depends on if they want to issue different levels of stock, they'll go to a C corporation. So for instance, if a venture capitalist comes in and they want to issue preferred stock, let's say, the venture capitalist may get a different level of stock ownership than an LLC member. Or an LLC member, they all have a membership interest, and there's no difference between one membership interest versus another. So from a financing end and bringing out in equity, a C corp may or may not, depending on the facts and circumstances, may or may not be more advantageous. The problem with the C corp is there's double taxation. So let's go back to our example. You and I own the C corp, and we have $100,000 of profit, and we take a distribution out where there's double taxation with the C corp. When you take your 90 out, well, the 100 gets taxed at the C corp level, and then you take your 90 out, you get taxed on your 90 as a dividend on your individual return, and I get taxed on my 10 on the individual return as well. So with the C corp, there's double taxation, which obviously is something you want to avoid. So depending on the facts and circumstances, kind of drives the decision on whether you want to be an LLC versus C corp. So, but I would say a vast majority of the clients I'm working with right now are setting up an LLC. When you set up an LLC, you can always elect to be taxed as an S corporation. So you can make an election down the road to be taxed as an S corporation. On the profits of the LLC, Howie, in our example, your $90,000 of profit as an LLC pays federal, state, Social Security, Medicare tax. If you become an S corporation, you only pay federal and state. An S corporation is a little bit different than a C corporation. But another reason why you might want to be an LLC gives you a little more, flexibility as far as what avenue you want to go down in the future as well.
So what about when you mentioned on the financing side? So if a e-commerce store is significantly scaling and they want to reach out for venture, a venture fund is going to have a requirement for the company typically to be a C corporation, right, instead of an LLC. So any quick comments? I know we could do a whole session on trying to convert from an LLC to a C corp and the pains and joys of that. But do you have just like a quick comment on that?
Yeah, I think they don't. When people go in for they're an LLC member, they may invest in it because they know it's going to lose money for the first 5 years, so they want the tax advantages of that. And venture capitalists really don't care about the tax advantages. Right. They're investing for appreciation and to exit out of it. Normally, that's a situation you may see on why a venture capitalist may want to go in to a C corp versus an LLC. And plus, you have the different levels of, you have common stock, you have preferred stock. They might want to be a preferred stockholder for one reason or another. Again, it really depends on the situation, but we have seen that those type of situations in the past.
Great. So let's talk a little bit about some of the roles and the relationships with partners and vendors. So can you talk a little bit about sort of bookkeeping versus accountants? Is it preferred to be in the same firm? Is it okay to start with maybe a local bookkeeper or a service? Because that comes up a lot. Like, oh, I have a bookkeeper handling my accounting. Well, it's not the same thing. Someone might be reconciling your books and whatnot, but that doesn't that's not what the CPA firm is going to do when it comes to efficiency of tax strategy and whatnot. So a lot of confusion on bookkeeping versus accounting out there.
So you don't want your accountant doing your bookkeeping because you're going to get killed fee-wise, and you want your accountant to be involved with the higher level tax strategy. So what's nice about our firm here is we have what's called our outsourced accounting department, and we have people that at a reasonable rate they go in and they work with the client and they do their bookkeeping, and they're not getting crushed with the $300 or $400 an hour fee. But the CPA is right around the corner if there's a question. Hey, I'm looking at this transaction. What do you think? We have our outsourcing, but we also have some really good bookkeepers that our clients have already engaged and are presently using. They can make the life of the accountant and the owner so much easier. You want your accountant to come in and look at your profit and loss and look at your balance sheet and sit down with you. Number one, do some tax planning. Number two, help you understand the numbers. Warren Buffett said it the best: accounting is the language of business. And again, a person who knows how to sell widgets, that's what they know how to do. But my best clients who've been successful at the end have known the numbers and have understood what an accrued expense is and how that affects your financials, and what an accounts receivable and accounts payable and how that works. And a lot of times that falls on us to hold the client's hand and walk them through the scenarios. The first time I go through it, clients look at me like I have crabs coming out of my ears. They don't understand the concept, which is okay, because this is, it's an evolution. Eventually we'll get there to make sure you understand the financials and what the numbers mean. That's what you really want to leverage your accountant on. You want to get a good bookkeeping firm, or if your present accounting firm has an outsourced department that you can rely on, I would heavily advise doing that. A lot of my clients, QuickBooks Online right now is very user friendly as far as once it's set up the right way. You can really take advantage of QuickBooks Online. You can spend 15-20 minutes a night downloading the transactions right in your QuickBooks, and you can do a half decent job. It's just like anything else. If you do it once a month, it's probably not a great thing. If you do it a couple times a week and spend about 10 or 15 minutes, it's probably worth your time doing it, just to understand the mechanics of how the numbers work.
So do you recommend for, let's say, a small or even a mid-size e-commerce business, is QuickBooks Online, is that the best platform? Is there any other software or packages that's worth considering?
So I would say about 98% of our clients use QuickBooks, and a lot of them are trending towards QuickBooks Online. Mm-hmm. I hated it when it first rolled out, because I was so used to QuickBooks Desktop. And you would think, okay, same name, just instead of desktop, it's online. It was like night and day, the two products. I actually use it for myself personally, for my own accounting, as far as spending the household money and whatnot, because I log on, I click the transactions and where I want them to go, and I'm done. It takes me probably 30 seconds a morning to do it, just for myself. Again, I'm a CPA, so I'm a little well versed on it. But as far as Peachtree's out there, I have a few clients that use Peachtree. Not bad. QuickBooks PC or QuickBooks Desktop is out there. Not bad. But through the rumor mill is Intuit is really putting their money towards QuickBooks Online. What I like about QuickBooks Online is I can log on. I can work on a client's account at 9 o'clock at night without asking them for their password or to log on remotely. I just log right into the account. You invite your accountant. They jump on. We can look at the book simultaneously. And because some clients might, hey, I just bought a new truck. How do I book it in my QuickBooks? And I'll jump right on with them. We'll walk through it. We'll generate the new account. Before it would be, all right, well, send me a backup. Let me look at your backup. I'll book it, or I'll give you the journal entries. It's just like anything with technology nowadays. It just makes you more efficient, and it makes the communication so much easier with yourself and your accountant by using the QuickBooks Online. And what also is nice for QuickBooks Online is YouTube has a ton of videos. How do I write a check? And they'll walk you through. YouTube has people on there that it's a 2-minute video with instruction. You can type anything in YouTube, and it's so extensive on how you can. I've had clients just learn from YouTube on how to use QuickBooks Online, instead of leveraging my time at $300 an hour to show them how to write a check through QuickBooks. They just go online and they look it up, and they have an instructor right there, and they can watch the video 10 times before they get it.
Excellent. Yes, and that's a resource that both Mark and I use in our own businesses, right, is we're using, and we pretty much migrated everything to QuickBooks Online. So what about some of the external bookkeeping firms, bookkeeping as a service? So so I'm working on a project now that's using Bench,
Okay.
and there's some other sort of almost they feel like bookkeeping online 2.0 or something like that. Any thoughts on some of those services versus QuickBooks? So it's sort of like beyond QuickBooks Pro, doing it yourself,
Right.
maybe a little different than having sort of a full firm do it. Is it sort of like an in-between step, or because it seemed pretty efficient so far?
Yeah, everybody's different on how they like to handle things. I mean, organizations like Bench have great reputation. Um, I don't know as far as it depends. If you're sending out the information, they're doing all the work themselves and they're sending it back, whether in a profit loss and a balance sheet. I just can't emphasize enough that which is fine as long as you sit down and try to understand the numbers and see, your your business should be more than just what's in your bank account. Um, you really have to look at the numbers besides the bank account. Look at the profit loss and see, how you did this year versus last year, what expenses are up and what expenses are down. And then you can look at your vendor list and see, if you have a concentration of just one vendor or could you outsource some things. But I'm a big proponent of what's good about a company like Bench is this is all they do all day. And they're very familiar with it and they do a very good job most times. And I mean, it's garbage in, garbage out. If you have an organization and that's not too good and just, they're putting bad information in the computer, you're going to get bad information out.
No, that's a great point. And getting this stuff done early in these relationships early is just going to save so much time and grief. So one of the topics that Mark and I have spent a lot of time and coursework on is how do you properly segregate your various business interests. So let's say someone owns 5 stores online and maybe they're all in the same corporation, which is not great. Maybe they're all dumping into the same merchant account, even worse. Maybe there's multiple merchant accounts going into one bank account. So let's talk a little bit about that, is how do we handle that? And then maybe the second part of it is doing a good job segregating and splitting out your personal expenses between and business expenses. So early on, you have a little store, it's a side hobby. It always matters. I don't want to say it doesn't matter, but like it's all right. It's a little little loose here and there. But once we want to formalize this and think about how do we get our house in order for a future investor, a business partner, or an acquisition, right? That stuff becomes big problems. So do you have any comments on how to deal with just putting things in the right silos if someone has multiple business interests, and then separately, like what's the best practice in getting your personal stuff like out of your business account and vice versa?
So and it depends. I have a client, for instance, that has 7 different businesses, and he has 7 different entities, which is fine. But if you have one entity and you have different stores, like you mentioned earlier, I know with QuickBooks, and I'll go back to QuickBooks Online, and Peachtree actually has this as well. My recommendation would do what's called classing them, and classing them would be separating them by store. So if you have store 1, store 2, store 3, store 4, and store 5, you can actually have it set up in your accounting software that when you get paid or when you send out an invoice to XYZ company, you can then tag that to store 1, because you want to have everything separated, because if you have everything in one basket, you can't see who's making me money, who's losing me money, what expenses are up, what expenses are down. By having them situated where it's segregated between each store, you can look at that store's revenue, that store's expenses, that store's payroll cost, and see what that store's adding to the bottom line. Again, it's just the numbers should be more than just something that you put on your tax return and you pay tax on. More importantly, the numbers should be telling the story of where your business is, where your business is going, and how your business is doing. This way you can make a decision. Do I open up store 6 or do I close store 4? So in my opinion is that if you do have one entity and within your accounting software, you do what's called classing them. And classing is just saying Class 1 is store 1. Class 2 is store 2. Tag your expenses to that class. Tag your income to that class. This way, at the end of the year or quarterly, when you sit down, or monthly, when you sit down and review your activity, you can see who's making you money and who's not making you money, and why is that? Because you may have store 1 that's doing really well, and store 4 and 5 they're doing horrible. And if you're just putting it under one roof,
Yeah, it's hard to tell.
it's going to be really hard to tell. So that would be my recommendation. And on the second question is, you really got to be careful with the personal items. My recommendation would be if you have personal items, if you're paying a car through the business, which is fine, and I do have clients that do that. Just make sure it's well documented, because you don't want to pierce the corporate veil where it's looking like you're running so many personal expenses through. It's really not a business. It's both. There should be, the reason why you incorporate is because you want to stick a wall in between your personal assets and your business assets, and that if something goes wrong on the business end, that wall's there to protect all your personal assets. I would be really careful putting too many personal items through. One reason is legally, and another reason is if you ever want to sell your business.
Right.
I had a client that was doing that, and they were about 5 years away from seriously thinking about selling the business. And I said, listen, we really have to clean this up. But if you have personal items, let's set up a section in the profit and loss where all these items are at. They're discretionary expenses. So when a potential buyer comes in, they can see that there are discretionary expenses within the business, and they've been identified. And that puts a potential buyer at ease that, okay, well, I know they separated them out, and I know the rest of the profit and loss should be 100% business related, and that could ease a potential buyer's mind of how the cash flow of the business looks.
Right, and then also, that would also be potential profit, right, for the buyer also. So if there's $100,000 in car and home office and other things that might be running through, if the buyer can look at that and say, oh, okay, that's really could be another $100,000 in profit for the business, in an example.
Absolutely. I mean, people buy business one of two reasons: for potential growth or cash flow. So you want to show, when you're looking to sell your business, you want to show obviously as much cash flow as possible.
Right, right. And then one of the things that Mark says all the time is people don't buy a business to buy a job, right? No one's trying to buy a job; they're trying to buy a business. And if you don't take care of everything that we're talking about here, then it's a job for them, because then they need to put in bookkeeping, then they need to figure all this stuff out. You can package this and they can look at it. They're going to be a lot more comfortable when they're doing diligence on their side, and it'll make their advisors, their accountants, their attorneys more comfortable when they look at a package and say, well, this is really well organized. It's a very different conversation when it's a mix of 3 different bank accounts and personal debit card receipts and all this other stuff. They don't know what to do with it, and then they start to not even trust all the numbers, right? So it brings a level of professionalism and trust to everything. So super, super important.
Absolutely. So, I've been through a lot of due diligence, and the process can be, due diligence on the sale of a company or even a buy of a company is always tough. The more organized, the better. And the due diligence process is never fun. It's almost like going to the dentist. Make sure you brush your teeth and floss your teeth. If you do that, going to the dentist still stinks, but it's going to be a little bit easier, just like with your books. Make sure you have backup and they're in order and they're organized.
Yeah, you'll bleed more at the dentist if you didn't floss, right?
Exactly.
Is a good way to think about it. Okay, good. So let's talk a little bit about an asset versus a stock sale. That comes up from time to time. So love to hear your thoughts on that. And obviously, if there's an LLC versus a C corp, it kind of makes it a little bit more complicated too.
Yeah. So I'll just basically, a lot of times I see. So if it's a client comes to me and says, I'm going to go buy Howie's business, what do you think I should do? Most times the answer is, well, we want to buy the assets of the company. If it's an asset-heavy company, there's some advantages to that. For instance, if the purchase price is $500,000 and the hard assets are valued at $300,000, well, you get a lot of write-off up front on that. So that's usually the main advantage of the asset sale. Also is you're not going to purchase the sins of the seller. So for instance, if it's a stock sale and you don't buy the assets, you buy the equity, you buy the stock of the company, you're basically the old owner stepping out of the shoes, new owner stepping into their shoes. And there could be something that happened a year or two ago that now you're responsible for. So which could be nothing, it could be really bad. So it's another important aspect of going into a sale. A seller loves to have a stock sale because they're going to get taxed the capital gains.
Mm-hmm.
A seller probably isn't too fond of an asset sale because they're going to have to recapture depreciation. And I don't want to get too technical on it, but the tax rate's going to be higher on that end. So a stock sale is more ideal for the seller, and an asset sale is more ideal for the buyer in those situations. But a very important part is if you have an asset sale, you're starting clean, you're starting a new company, and you don't have to worry about the sins of the past of the seller. Where if you're doing an equity or stock sale, you might be looking around the corner for the next couple of years on a potential lawsuit. They didn't pay somebody, an HR issue, who knows?
Right, and that's a great point. It's sort of that this is one of the points where it's the difference between the view of the buyer and the seller. In general, on both the buy and the sell side, everyone needs clean books. Everyone needs taxes filed at the right time. Everyone needs to make sure that everyone's, fees are paid correctly and whatnot. But this is one of the points where you see a big difference, and that's a great point between what the buyer might want and what the seller may wish for. My experience on this, it goes back to almost the golden rule. Right, so whoever has the gold will make the rules. So much of this is dictated by the buyer. So the seller's like, really want a stock sale, but if the buyer's like, well, I'm only doing an asset sale. There's, it's unless there's a special situation where seller has so much power in the bargaining chips, maybe they can. But in general, this is one of the things where you might have a goal as the seller, but this is one of the things that the buyer will many times dictate. And if you want to close a sale, you kind of have to work within their world. So, but yeah, it's interesting that most of everything we're talking about helps if you're just starting out, or if you're already doing $1 million a month. It helps if you're want to sell your business in 5 years versus next quarter. And it helps in planning to make it easy for the buyer to transition to the business. But that specific question, that specific topic, you just have to see kind of where the market is and where the comfort of the buyer is. And it has many implications to it on both sides, but it's one of the things as a seller that maybe you don't have as much control over, right, for good or bad. So what trends, since you're seeing so many clients, what trends are you seeing today in any clients trying to sell their business? On our side, we're seeing heated up, accelerated multiples for e-commerce and digital businesses, just because everything kind of that happened with the pandemic and kind of how the world is shifted. Do you have any sort of general trends that you're seeing for clients on the sell side when you're representing a client that's looking to sell their business? Or marketplace trends?
Yeah, that's a good question. I mean, the multiple, it's funny. We had a client sell about a year or two ago, and they were in the events business, and luckily they sold when they did.
Yeah, luckily for an event business.
For the seller, buyer isn't so lucky. And it's funny, Howie, we actually, leading up to the sale, we issued a high-end financial statement, which is an audited financial statement, which reassured the buyer of the numbers, and they actually got a higher multiple as a result of it, because the numbers were a lot stronger, and they could rely on the numbers. The reliance on the numbers was a lot stronger. That's one situation that really jumps out to me. I mean, I've had deals lost where people have walked away from the deal just because the books weren't in order. There was no software to go back and confirm some of the numbers they were using. I had somebody that I went in to do evaluation for because they wanted to make sure the offer they had was legitimate, and I went in to do my due diligence. I said, "Where's the numbers?" And she gave me a piece of loose leaf paper and said, "Here, this is what I give to my accountant." And I said, did you give this to the potential buyers? She goes, not yet. I said, all right. Well, so eventually she gave it to the potential buyers, and the multiple she ended up getting was zero because nothing was. I mean, it was a mess. Um, so, but as far as on that, I had a client that I did again, it depends on the buyer too. I had a client, I would do a valuation for every other year, and we came up with a value of about $600,000 to $700,000. He went to a potential buyer, came back to me, said, I got $3 million for the sale. So, and basically what it was a strategic buy. They were buying the top line. They got rid of the entire staff, and the buyer was just buying his revenue. He didn't care about his net profit because they had all that in place. So it depends. It really depends on the strategy of the buyer and what the intention of the buy is for. So, and in that scenario, it was great. I mean, the guy thought he was going to get maybe $600,000, $700,000, ended up getting $3 million.
Right.
So,
Good day.
yeah, it was a good day, and but it just depends on what the motivation and the strategy of what the buyer's going in for.
So what have you seen as some changes between sort of, maybe pre-pandemic, maybe going back a year or two ago versus, kind of in the middle of, or, hopefully ending sort of a pandemic? Have you seen any changes with either, the operations of some of your clients, or even more specifically on the valuation or the sell side?
So I had a client that was supposed to sell last January, got held up for one reason or another, and they were going to close April 1st,
Mm-hmm.
and ended up closing because of the pandemic. I think the pandemic just kind of scared everybody off. No one knew what direction we were going to go.
Yep.
And he ended up selling in October. No difference in the sales price. It was more of a fear of the unknown at that point. So people backed off. I just know on our end, Howie, in our business, we've been forced to be more efficient from a technology end. For instance, we invested in a software. It's something like a DocuSign system, but for accountants. Something that's taking our admins in the past 3 hours to do is now taking an hour,
Mm-hmm.
which is huge, huge from January 1st to April 15th in our world, because we're so busy with tax season and every minute counts. I know myself, I'm doing a lot of Zooms or Teams or go to webinars
Right.
with clients. I don't have to jump in my car. I'm not walking downstairs, talking, bringing them up to the conference room, walking them back. Doesn't sound like much, but when you're walking down the hall and 2 or 3 people start talking to you, next thing you know, 2 hours have gone by. Where now it's a 15-minute phone call, I'm off the phone and I'm on to the next one, or I'm jumping on the next client. So I just think the efficient people really taking advantage of the efficiencies of technology. I was on the phone with a client yesterday, have a big investment firm, and they don't plan on being back in the office until at least after Memorial Day, and they're doing everything through Zoom and Teams, and they've been efficient. They have a big building down in Center City. I don't know if they need that rent anymore. So I just think landscaping could change. If you're not paying $5, $10, $15, $20,000 a month in rent, cash flows go up and it could add value to some businesses.
Interesting. Any change in valuation, or is it too early to see?
It's a really good question. It's funny you say that. I get a call from an attorney last week. He's got a couple divorcing. They're on pretty good terms and they need to value their business. I said, all right. So I get on the phone with them, and their business is really tied towards theaters, okay, and on Broadway and those type of things. So they have been shut down since March.
Yes, yeah. There is no business right now, right?
No business, none at all. So in order to get divorced, it's the biggest asset they have, and they need to put a value on it. I said, okay, we can do that. I said, do you have any idea what's going to happen in the future? And they said, we have no idea.
Yeah.
I said, when do you think you will? They said, probably within the next 4 to 6 months, we'll know whether our business is going to be back on or whether we're going to shut down. I said, my advice, and I hate to turn down business, but my advice is let's wait. We already set a time in June to talk. I said, do you have to rush through this valuation? You have to get the value done, because you either value businesses one or two ways. You look at the past,
Right.
or you look in the future. Well, the past, they said the past is no, we have no idea if we're going to continue to do these numbers. I said, all right, well, we can't use the past. What about the future? We have no idea what we're going to do in the future.
Yeah. So what do you do?
I said, what do you guys want to do? So we're going to value the biggest asset you have on a whim, on a maybe. I said, let's wait 6 months. Let's wait until the vaccines are out, and let's see how the theaters are going to roll things out, and let's start back up then. So so that has been one effect of the pandemic. Now I have some clients that are doing extremely well. I'm doing evaluation of a company right now that's in the pool industry. Pool industry was booming.
Everyone put in pools. You couldn't get them built fast enough. Even on the East Coast, you couldn't get your permits quick enough. You couldn't get anything done quick enough. There was so much demand.
So they're gifting ownership to the next generation. And I said, well, I don't know. I mean, it's great you guys are doing well, but it might artificially inflate the value of the business, because if this isn't going to sustain,
right,
then it's we're going too high. So it's really been a moving target, Howie. It's just been really tough to come up with values in this area. You're either down tremendously or really up. And is that an indication of future value? Probably not. I mean, obviously you want to, it's a steady work of numbers to go with, but the pandemic has really made it a lot tougher. I put some work off just so we can get back on better standing and see how things are going to be in the future.
Yeah, that's a great point, because it's either what the past was or your confidence in what the future will be.
Yeah.
And if the past was boom, 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 and then all of a sudden like this, or even higher too, that's sort of what happened too, is you had a lot of businesses that had, like the pool example or whatnot, that had these big jumps that wouldn't be from a typical seasonality or typical cycle, right? And then, so how do you value that? I'm sure they'd love to just sell off the last, whatever happened in the last trailing 6 months or 12 months, but that's not the reality of the business over the last 5 years, or not, an indicator of where the business will be in the next 5 years. So yeah, that's a interesting topic, right? We could do a whole nother session just kind of on that.
And it's funny because normally if we do a weighted average of 5 years, which is usually normal business cycle, we usually weight the heaviest the most recent year.
Right.
Well, now it could be the opposite. We may weight that the lowest number because we just don't know if that trend's going to continue.
Right. Or it could be lower now again, or it could be much higher. So you put too much weight on it, it's going to artificially value it. Yes, super interesting. All right. So my last question is, if there is one suggestion, one thing that an e-commerce store owner today that is, let's say they're operating their business maybe in the first year, or just a year out, and they're kind of doing this themselves, or just not doing a great job organizing it, what's the one thing that they can do to clean stuff up before they bring it to you? What's the one tip before they show up at your desk with a big file, box of receipts all over the place? What do they do? What's the one thing?
I'm going to give you a quick story of a client that just recently sold. It was awesome. It was awesome to see, because he was a client for 15 years, and he always told me he had a plan. And I thought his plan was to rack up as much debt as possible and not sleep at night, because that's what he was doing. He knew the numbers. He came from the banking world. We had a great relationship. We would have a hit by the bus meeting lunch once a year.
Yep.
He would say, all right, if I get hit by the bus, here's my information. Let's go over my profit and loss. Let's go over my balance sheet. My recommendation would be, and this isn't a shameless plug for the accounting industry or try to generate fees, but is to have a relationship with your accountant that you communicate at least twice a year. At least twice a year. I mean, whether you're looking to sell your e-commerce business or you're looking just to maintain your e-commerce business. And I don't care if it's e-commerce or if you're selling widgets. I mean, at the end of the day, am I making money? Am I not making money? Do I want to sell the business? Is this something that's attractive for a sale? This client had his books were in order. He understood the numbers through the help of us. We helped him understand the numbers. He just doesn't say, all right, here, where do I sign with the tax return? He looked at every number and made sure he understood it. Now, when it was time to sell, the due diligence process went a lot easier. And they sat down, they knew everything was there. And I mean, there's nothing worse than getting a client's accounting software and seeing that they have negative cash of $15,000 in the bank, or their credit card balance is over by $25,000, which is just mistakes. It's just they're just putting it in, and it just doesn't make any sense. It takes time and money for everybody to figure out what's going on. My best advice would be to anybody can put numbers on a piece of paper. I tell clients that, the new clients, we're not here to put numbers on a piece of paper. I can get anybody, you can get an HR Block or Jackson Hewitt to do that. Great places to get your taxes done. But you want somebody you can build a relationship with, communicate with, and trust. And it's funny how I get clients, when a new client comes over, I say, how come you left your other firm? Was it because of fees, this or that? And the answer I get the most is he or she made me feel stupid when I asked the question. Because accounting is, it's a difficult industry. And I always tell them, I'm not smart enough to make you feel stupid. So please ask me as many questions as you want, because my life gets a lot easier at the end if you and I are communicating as much as possible to get the desired result. And why that story was so great, I mean, of the client sold, just a great guy. He really respected the services we gave, paid attention to the work, and just really paid attention to the numbers. And we had some really good conversations. They weren't all like that in the beginning. I mean, it was a lot of the ABCs of accounting, but he listened. He took a lot of advice from us, and it just so happened he ended up selling his business for $2 million, and now he's doing a lot of charitable work, which is really awesome to see.
Yeah, yeah, it's a great outcome because he asked questions and he listened, right? That's a good way to look at it.
Don't be afraid, and listen, don't be afraid to ask the questions. And I get it all the time. This might be a stupid question. Usually the stupid questions are the most basic ones that could really screw you up.
Right. Awesome. Well, thank you, Michael. This was really informative, and appreciate your time.
Thank you very much. And if anybody has any questions, please don't hesitate to reach out to me.
Yeah, so we're going to have Michael and his firm's contact information available in the resource section, so you'll be able to communicate and reach out directly to Michael. Thank you again, Michael. Appreciate it. Be well.
Thank you.
Thank you.